Hello, everyone. Jeff Fratarcangeli here, Fratarcangeli Wealth Management, here for another live market update and call to action. Interesting times to say the least, mostly positive, at least from the market's perspective. But before I get into that, a little bit about Fratarcangeli Wealth Management. For those of you that are joining us for the first time or watching the replay of this particular live event, Fratarcangeli Wealth Management has been in business for 30 years as of this year. And we're comprised of over 40 professionals with over 300 years of experience. We're holistic wealth managers that work to guide and counsel our clients through the many decisions that they have to make in their businesses and their personal lives, and navigating these ultimate objectives, near term, intermediate term, and ultimately long term and legacy. And that involves investing, diversifying, positioning yourself to have the optimal outcome relative to your ultimate goals when it comes to money, but also take the least amount of risk in the process. And there's many attributes that come into play when you consider the bigger picture of holistic protecting and guiding clients through these mazes. And that is, what does their balance sheet look like on both sides? What's their liquidity? Are they prepared for the unforeseen? Do we have them protected and being able to overcome something like a financial correction like an '08? And also, are they making sure their assets are growing and combating inflation? But in addition to that, you have their benefits, their property casualty, making sure that their health benefits and their property casualty protects them from the unforeseen. And we make sure that we're involved there. Their debt, whether they're borrowing or considering borrowing, what options are available to them? How does it benefit them? And are they over leveraged? These are things that we can help them find a solution for relative to leverage within our organization. We're attached to Wells Fargo on the custodialship and the platform as it relates to the bank. But we also have other institutions we can leverage for those needs, commercial and personal. And so the whole gamut. And in addition to that, the estate planning side, we make sure that we're cognizant of the financial picture and the objectives of the business and the personal side for the clients we represent. We have the benefit of representing predominantly business owners, executives, and families of the like that need to have the at their fingertips the solutions necessary to navigate the situation. We also have and been working with those in the sports area, the professional athletes, as well as entertainment. A little bit of fun involved there for me, but really tie the two together as well as we look at the path. And then we bring in our external resources, research, analysts, a number of individuals. I'm going to introduce a gentleman here momentarily that we leverage. We leverage First Trust. We leverage this gentleman, Andrew Opdyke, at times that we think we're at a pivotal point. And I believe we're there. Today we have, I believe, cautiously, but I am more optimistic about this economy and this market over the next couple of years than I probably have been in my 30 years of doing this, for reasons of, and you don't want to hear from me as much, but I'm just going to mention the amount of liquidity in the system, the access, the deregulation that we're facing that'll take some time to make its impact to the economy and ultimate decisions being made. It's the bloodline. Imagine if you had a Ferrari engine, but you had no gas or oil. Doesn't matter that you have a Ferrari engine, you're going nowhere. And we have an economy that's in a position that I think is poised for major expansion. But do we have enough liquidity? And the answer is yes, due to the fact that the regulation or deregulation is going to allow the banks to essentially inject that capital into companies and into the industries that are demanding it in this next turn. And I think that is the most important thing. I'm curious what our guest, Andrew, says, but I think that's one of the bigger points. We have the big, beautiful bill that was signed on July 4th. That's one of the main reasons we came together today, to understand how it affects us in the investment world, how it affects our businesses. We're going to talk about that as a headline. And then, of course, the uncertainty of tariffs. What do we have still to concern ourselves with? The market seems to be somewhat calmed about that continued kind of cloud above us. And then finally, let's not forget the technological advancement that I've called Chapter 2, also referred to as AI. I believe that's going to be explosive. I think it's going to have so much impact for efficiencies and productivity and a lower cost of doing business. A perfect formula for economic growth and activity to the expansion side. So these are the things that make me excited, but I have to, one, primarily position ourselves to protect against the unknown as well as the known. And so that's our protect, take advantage, and consider all factors that could come back to bite us. And that's exactly what we do at Fratarcangeli Wealth Management. And we leverage our resources. And Andrew, I had you on back in April when we had this tariff announcement. And,
Hmm.
we remember that big board that our president walked through as to what the tariffs were going to be. And everyone, of course, was on pins and needles to understand how that's going to affect their businesses and the markets. And I got to tell you, Andrew, I brought you on for the first time. I was extremely impressed by you. So before I introduce you to speak and answer my first at least question, I'm going to just give a little background, Andrew. Andrew, you're a CFA, a certified financial analyst. You're a graduate with an MBA out of Northwestern University at Kellogg, one of the top institutions. You are a senior economist over at First Trust, which has recently been honored with one of the top rankings as it relates to research and leadership. I mean, it's why we've leaned on First Trust. It's why your team of Brian Westbury and many others of the like are so respected. And you don't tell us what we want to hear; you tell us what we need to hear. And so, Andrew, I'm bringing you back, and I'm excited for our audience to hear what you have to say relative to this big, beautiful bill and all other factors. And, listen, we've heard that this big, beautiful bill, as it's being touted as, and its growth, some say it could add as much as 2% to the GDP growth. That's exciting to think. Do you see the additional impact or any additional impact reaching these targets? And what says you, Andrew, to
Yeah.
kick us off?
Well, yeah, Jeff, first off, thank you for having me back. It's wonderful to join you. We're going to talk about a couple things today. Before I jump in, I'm going to walk you through a couple slides in terms of what we're seeing. But yes, in a year 2025 that's been filled with a lot of uncertainty, and we talked back in April, even in the last 2-3 weeks, there's still question marks. Yesterday, I was having conversations. We deal primarily with U.S. based, but I spend time talking with groups internationally. Yesterday, I was talking with groups from Chile and Peru and Mexico, and just in the morning when we were on that call, the news alerts start coming through with rumors that Trump is going to fire Powell, and we start talking about that. 43 minutes later, news alerts come through saying that's no longer true. We've been living through this period of significant uncertainty, and that impacts how companies and individuals operate. If you look at the first quarter of this year, the GDP data that we had, US GDP went negative, but that was entirely due to a surge in imports, right? It was companies saying, we don't know exactly what's going to happen. And so as we look forward, we plan for the future, plan for what we can potentially see. They brought in a lot of imports, and now that is starting to change. We're still sitting here trying to figure out the tariffs. And now, with the one big, beautiful bill, we have a little bit of certainty. And I think that is critical. Now, there's a lot that goes on within this bill. It is a big piece. It impacts a lot of different areas. It impacts corporate investment. It impacts their earnings potential as we progress through this year. It has impacts on personal taxes. There's a lot of people on here who I know have more complex tax situations because the high performers, high earners, starting companies, running companies, selling companies. And so there's a lot of ramifications for individuals. This is the perfect time to sit down with Jeff and the team and have that discussion. But let's talk about a little bit of what it does for organizations. So in order to do this, let me pull up a couple slides. And I want to start with earnings. Right, because this is to me at the end of the day, this is something we should always be paying attention to. Always look at the earnings power of US based corporations. You'll notice over the last 2 years, one of the struggles that we've had is that earnings growth, well, the market performance has been incredibly strong. Earnings growth has been kind of modest. Now, this year and into 2026, that is turning. Some of this relates to, as Jeff, you mentioned, significant investment in areas like AI, significant investments in energy infrastructure, which are ongoing. Just earlier this week, Google announced they're going to be spending $25 billion in order to redo two facilities, water turbines, in order to support their AI and data infrastructure. That's one of countless projects that's been announced throughout the year. Let's go back to and remember what happened the first time we got the tax cuts. Okay, 2017 into 2018. Now this time is different in terms of what's going through. There was questions on where the corporate tax rate would flow through here in 2025 into 2026. The 18 tax cuts that, as a reminder, moved us from 35 down to 21 on the corporate tax rate. That 14% cut led to a boom in earnings growth in 2018. Now, there had been discussions late last year, early parts of this year, even as recently as a month or two ago, on whether or not that 21% number would move even lower. We didn't end up going that direction, but that doesn't mean that there isn't still an earnings tailwind that comes from some of the tax changes. Well, we're not going to 18. One, we have the certainty that the 21% is now permanent until a future Congress changes it, which could always happen. Congress has that ability. But for the foreseeable future, 21% is in place. But two critical things that I want to note. One, okay, we're getting a return of the accelerated depreciation. And if you remember this, back in 2017 to 2018, one of the reasons that we saw a surge in both earnings growth and corporate investment is that companies had a greater incentive to put capital in place. And if you've been watching what's been happening around the United States over recent years, one of the biggest trends we've had, 23, 24, it really started back in 22, was this absolute surge in manufacturing construction that has taken place in the US. Now, this may seem a bit out of place if you look at the broader economic spectrum. If we go and look at the activity that's happening on the good side of the economy, or you listen to reports, there's a report, the Institute for Supply Chain Management, that goes and talks to these businesses. These businesses have said, there are certainly pockets. The data center, the energy infrastructure, the AI, again, has been a key piece, but some parts of the goods industry have kind of gotten ahead of itself. The service side of the economy has been leading over the last year or two or three. You wouldn't have anticipated, the Fed certainly didn't anticipate, that during this environment where goods activity went a bit sideways, in a time period where, remember, right, interest rates went from near 0% going at the end of 2021 to closer to 5%. I don't think they anticipated we would see this level of manufacturing construction. But the reason I bring this up, and I think this is so important, is that the 100% depreciation schedule that went into effect in those early days tapered off. Okay. So in 2025, that level was set to be 40%. In 2026, 20%, then ultimately be eliminated in 27. That is no longer the case. So now we're going back to a 100% depreciation schedule. And this activity, right, property, plant, equipment, things going in place, companies have they have at least $250 billion in deferred tax assets that they were going to be applying over the next year or two or three. And now they're going to be able to pull that forward here into 2025. There's also new tax cuts that are happening on the R&D side. They are very much focused on R&D spending. And as you mentioned, arguably the biggest piece, and this is outside of the bill, is that deregulatory front. You'll notice, right, that boom we had in manufacturing construction activity. And parts of this at the beginning, this was the CHIPS Act. This was the Inflation Reduction Act. Those definitely had impacts. What we're seeing of late is an absolute boom in corporations saying, now we're doing it because we see opportunity. If you walk through and you go through the news and think about the announcements we've had across spectrums in the automotive field, we've got Hyundai bringing steel plants to the United States. Toyota said they're going to build a $14-16 billion battery facility. We've got Honda saying they're going to be moving some of that auto manufacturing production on the chip side. Whether you're talking about Google or Meta or Amazon or Apple, across the board, these organizations are saying, yes, we are seeing returns to this investment. We are seeing really an exponential growth in the capabilities of our technology, and we are going to continue to invest at a rapid pace. Now, beyond this, beyond what we see here, there's also going to be an impact from international. And this has been a really interesting one. If you go back again to where we were, let me go back to the earnings numbers. You must understand the earnings in the United States are unique. If we were to look at the MSCI World ex-US, there is really no other country that has this earnings production that the US has. And if you've listened, Jeff, I know you had Bob Carey on about a month ago, and you were talking about the earnings growth in the United States, the earnings power. I don't think a lot of people realize that today, even before the tax cuts, we were sitting here at a point in time where the return on invested capital for U.S. organizations stands at the highest levels that we have seen. You go back a decade, 2 decades ago, you were seeing a 6 to 8% return on investment. Now it's closer to 10%, and we've had faster asset turns. Our leadership in terms of the technology world, our leadership on the financial world, it kind of pushes us in this direction. Now, other countries have been incentivized to start acting. And in the last year or two, quite honestly, I think it was a net positive for Europe that, Trump came in here, started talking about tariffs. It really caused the European Union to look inward and say, hey, guys, we are not competitive. We have put ourselves, whether there's tariffs or not, we need to start really seriously considering whether we have the skill set, the capacity, the rule of law, the regulations that would allow us to compete. But one of the pieces of that came up as tariffs were going back and forth, and I don't know if a lot of people realize that this was kind of involved in the bill is when the House was putting together the one big beautiful bill that they were putting forward, there was discussions about taxation on foreign citizens in the United States. It was called House Section 899, and it made a little bit of news and then it kind of went away. But this actually ended up having a notable impact because the G7, right, a lot of European countries, foreign companies, had been putting in a minimum tax. They were talking about raising taxes, and particularly in the tech field, they said, we want to get more tax revenue from any activity you're doing here in Europe, any activity you're doing in Germany, the UK, wherever it may be. And when the Trump administration announced this, the G7 said, okay, we'll come to an agreement. You don't do that, and we will exempt US corporations from this minimum tax. So there's also a net benefit. If we look at these numbers again, and we focus on the earnings, there is a net benefit that will flow through this year and into next year for the foreseeable future. That it ranges anywhere from 2 to 3, up to 5 to 7% in terms of the return, the earnings growth that can now be attributed to international business for U.S. corporations. So, when I take the one big beautiful bill, there's questions on what does it do to the debt. The thing to remember here is this wasn't really a debt bill. When we get later in the year, we get to August and September, that's the time for the appropriations. That's when we will see more of the budget discussions for next year.
Andrew, can I interrupt
what this
you for a
bill
second?
was meant to do, and I think it really did do it, is it, one, provided certainty. Two, it provided us with a tax-advantaged environment. The U.S. effective rate for corporations is around 17% now versus 21, 22% over in Europe. Now the focus is going to shift towards regulation, energy regulation in particular. I mean, Jeff, when you think about it, if you wanted to build a business, if you are based here in the United States or in Europe, if you're in Asia, if you're in India, and you wanted to build a business, you're confident in the product that you're creating, you're confident in your capacity. I think the U.S. has got to be the most attractive environment to have the certainty of the lower tax rates, lower than virtually anywhere else now in the world on the corporate front, the greatest access to energy, cheap, abundant, and critically reliable energy that looks like it's going to continue to move in that phase. You've got the best educational talent coming out from these universities. And yes, there is still uncertainty related to tariffs, but let's be real. If we look back to when we talked in April, if we've watched what's happened since then, a lot of this has been escalated to negotiate, right? How long were the tariffs, the Liberation Day tariffs actually in effect? 13 hours. Okay, 13 hours, and then they got delayed. There's more discussions to be had. There's more work to be done in those spaces. But I think, Jeff, at the end of the day, the combination of deregulation, movement on some of these taxes, incentivization to bring activity to the U.S., and now a cleaner environment on the tax front, this is kind of unleashing prosperity. Now, real quickly on the personal tax front, there's a lot of things here. If you are a small, mid-sized business owner, this is going to be critical. This is something I would watch closely this year. A lot of people are asking the question, will the Fed move? I do believe they will move. I think they're going to move 2 times this year, 2 more quarter point cuts. Right at the moment, I think they may start that. Originally, I was looking at September. They're kind of on the fence on that one. Watch jobs, okay? Because this is an area where we have seen a little bit of the pullback coming from those small, mid-sized businesses that were feeling regulatory burden. They were starting to see some of the pressures. The jobs number is one of those numbers where you have to dig beneath the headline. The number comes out. It came out a week or 2 ago. It got celebrated in the reports. But if you've been watching what's happening underneath the details, one week of the month, Jeff, I travel, and like you, I know you travel across the country. You've got offices across the country. You're talking with the business owners. So we get to have these conversations with the true capital allocators, the true investors in our economy. And I talked to many of these, whether I was down in Florida, I talked to a couple in Beverly Hills, in Chicago, in New York, and they said, why are we not in some of these areas? Why is our experience different from what we see on TV? They said, look, our jobs market looks a little different. It doesn't seem the same today as it did, let's say, go back to 2018, 2019, pre-COVID. And the reason for that is that the performance over recent years, over the last 2-3 years, before these changes in the policy that have now shifted and tilted towards small and mid-sized businesses, towards the private sector, was putting a lot of that allocation towards the public sector. The growth in jobs over the last few years was very heavily led by government and healthcare. And healthcare in particular was a lot of government programs, particularly out of the state of New York. I was there last week in Albany and Saratoga talking to some of the groups there. This is what I would watch. Watch for the unleashing of the creators, the entrepreneurs, the innovators, the wealth creators. This is what we really need to see from that sustainable growth standpoint. I think what we will see. So you may not immediately see it in the headlines. You may not immediately see it showing up in 2025 in the GDP numbers because they're going to be clouded by trade. But I think in 26, 27, as we move beyond, you're going to see, hear, and feel the impact of these changes taking effect and incentivizing the creators to create. I think that is an absolutely fabulous thing.
Outstanding. So I'm just going to, can you hear me okay, Andrew?
Yep, gotcha.
Yeah, I'm
Yep.
just going to say a couple things to kind of summarize what I heard, and you can correct me.
Hmm.
I heard you say that the clarity was the biggest probably impact, just knowing
Hmm.
what we're dealing with from a tax perspective, with some,
Hmm.
irregularities as it relates to the tariffs, but reiterating the fact that we had less than a day of actual tariffs being in effect. So it's
Hmm.
a lot of barking, yet we're seeing the uncertainty creating a little bit of a concern, but the clarity of the tax bill and the motivation that the tax bill brings. So
Hmm.
you have a couple factors. You have the forward, some of the tax benefits to 100% depreciation on purchases and expansion that companies are doing, not because of the potential tax benefits now because it's permanent. They're doing it because of the opportunity. And
Hmm.
then you're saying that the job creation outside of healthcare and government is what we need to watch for.
Yep.
And the Fed is seeing in these charts the same things we're seeing today, and that is not necessarily as robust as if you take out the government and healthcare jobs. And if
Hmm.
you take that into consideration, the Fed most likely, because of the change in government and how they're operating and not necessarily building jobs and being created by programs, now you have to really realize that the jobs are being affected on the call it innovator side or the businesses expanding the call it public sector and not the private sector,
Hmm.
and that is really what we have to watch for, which calls for a reduction in rates. We're hearing September a quarter of a point. You're saying you think it could be as much as 50 basis points. I have to push back on that. And I have to push back on that because the market is thriving. Okay. We're seeing major opportunities as it relates to investment and investment growth opportunity. And how much do you think that'll be taken into consideration? I don't want to get down a political rabbit hole, but the reality is we were data driven at one point. Now we're not data driven. And now we look at the markets expanding and the benefits of moving forward some of the tax benefits for earnings. Will that, in your opinion, cause maybe not quite the right move as it relates to creating more, uh, call it easing, if you will, by lowering interest rates? I'm pushing back because I have to, when I see the market moving in the positive sense, the Fed usually doesn't act. Whereas if
Right.
I see a negative reaction, we tend to see some things occur to motivate that process. But you're pointing out things that underlying, as we peel back the onion, are major factors. So, being the devil's advocate, how do you think that Jerome Powell or the Fed will operate, and will they do the right thing relative to the points that you just made?
Yeah, no, and that's a great question. Now, let me clarify. I think that we'll see 50 basis points, a half percent of cuts by the end of the year. I don't think they're going to move 50 basis points, a half a percent at one meeting. I think right now that the base case, and I was looking at the forward projections, the interest rate probabilities that people are basically betting on in the futures markets, they're basically saying they're expecting to see 25 basis points in October and then one more in December. Here's the thing for the Fed is the Fed has tried to say again and again and again they're going to be data dependent. They do that when it fits their narrative. They moved away from that at times when it didn't fit their narrative. I mean, I would argue if you look last year, and I don't want to get political, but if you look last year, they cut by a total of 1%, 100 basis points during a time period where inflation was stalling out. It was moving sideways and it was not at their 2% target. But they have their dual mandate. What they are tasked with is employment and inflation. So we have to ask these two questions. Where do those two stand? Again, on the employment front, the jobs numbers are moderating. They're moving a little bit slower. A year ago, year and a half ago, we were getting 190,000, 210,000 jobs per month. Now we're closer to 150 to 160. Now, the initial claims numbers, the unemployment benefits are still low. This is something that a lot of people were talking about with a crackdown on immigration or things that were happening on the tariff front. That there was prognostications that this was going to collapse business activity. That hasn't been the case, right? What we've realized again and again and again and again throughout history is that one, our emotions always cause us to overreact, whether we're talking about political reaction, whether we're talking about market and investment reactions. You know this so well, is that emotions can be a useful tool, but they shouldn't be our guide. Data should be our guide. Having a plan and understanding what we need to watch, what we need to track, helps us to have a clear vision. As you mentioned at the beginning, there's about 72 teams that forecast with Bloomberg the outlook on the economic front. Where do they think employment's going to be? Inflation's going to be, trade, retail sales data like we got this morning. Of those 72 teams, we are the number two ranked internationally. We've been in that top two, three, I believe now for 28 consecutive quarters. And we attribute that to constantly going back to the math. So if the Fed is going to watch it, right, they're going to see a little moderation on jobs. Now they've looked at that and said it's still robust enough. The unemployment rate is low. I don't think they need to cut by 50 basis points today. I don't think they need to go down 100%, 100 basis points, 1%, 2%. But I do think they're going to see some pressure to move. Again, right, if we see some pullback coming from government, and I think you will start to see this. A lot of this, I should be clear, this isn't federal government hiring. So when you hear about the Department of Education or USAID, this is not the hiring and firing that was taking place there that's really impacting these numbers. A lot of this is state and local, and it's very tied in to tax revenues. So this number you would expect to moderate a little bit. It went higher in the post-COVID impact time period. Part of this was inflation. As this moderates, I do think you're going to see that employment number continue to move a little bit lower. But the other thing is really with inflation. And on the inflation front, I think the Fed has the tariff picture wrong. Okay. And I want to walk you through why that is the case. And I'm going to simplify things. This is the example that I use when I'm having a conversation, let's say with my mom. And my mom, she didn't take econ classes. But when we were having conversations in 2020 and I said, Mom, you need to be prepared because I do think inflation's coming. And she would turn on the TV. And if you remember during this time period, Jerome Powell and the Fed was saying, don't worry about it. It's going to be transitory. I said, look, here's how the world works. If you want to understand inflation, it's two things. It's how much money do you have to buy things and how many things are there to buy. So we use this example with $10 and 10 apples. If you have $10 and you have 10 apples in an economy, they're going to cost $1 per apple. The money chases the goods, the market clears, and prices are set. Now, during COVID, we got inflation because both sides of this were impacted. We had more money that was out in the system, the PPP loans, direct stimulus checks, additional unemployment benefits. And at the same time, we had shutdowns. We had shutdowns and we had constraints on operations in the U.S. If people think back and remember, the Port of Long Beach was shut down and it was taking, 11 days for ships to come in, dock, and unload. There was 111 ships waiting offshore. And during that time period, March and April of 2020, we lost 20 million jobs in the United States. That's roughly triple what we lost during the entirety of the financial crisis. And you consider that and say, look, we have people not working and getting paid more than when they were working to not work. During that environment, we said inflation is almost inevitable. Now, the Fed, okay, again, they have to go back to their models, and their models are different from our models. So let's test the accuracy of models over time. They said, don't worry about it, because here's what's going to happen. Apple 6, 7, 8, 9, 10 are going to come back, and ultimately prices are going to go back down. And I said, well, I do agree that prices will come back a little bit. I do think that we'll get GDP back to 100%. But if we get back to full production, and in the United States, GDP, the output of a nation, once we're at kind of full employment or close to full employment, in a strong year, inflation adjusted, we grow 3%. 4%. The idea that we could grow 20, 30% above where we were back in 2018, 2019, I mean, that is going to take a significant amount of time. So really the focus should have been on how are we controlling money in the system? Are we taking it out? Are we putting more money in? With $13 and the economy back at 100%, we said, look, we're not going back to $1 per apple. That pricing is going to flow in. So we got our first test. If you remember back in 2021, and you can look at this because the Fed, one of the things they do is they make forecasts. Every other meeting, they put out the projections. All of the board of governors, all of the presidents at each of the Federal Reserve banks, they put their forecast. Where do they think inflation's going? Where do they think employment's going? Where do they think GDP is going? And as a result, where do they anticipate that they need to go? So they put all their numbers together and they've got 400 plus PhDs in economics working on their staff. And they said, look, based on our analysis of what's going on, we don't think that money matters. We think you can kind of ignore that. We believe that inflation will be down to 1.7% by the end of 2021. Now, we've lived through this. We can go back and test and see how close they were, how accurate were their forecasts. And if you remember, at the end of 2021, inflation was at 7.0%. Okay. So to their credit, they got one of the numbers right. Okay, there was a 7 in there in the final number. They had it on the wrong side of the decimal point. Then they told us in 2022, look, we're going to raise rates because it turns out you're right, it's not so transitory. Okay, inflation is here. So here's what we're going to do. We're going to raise rates 3 times. Remember this at the beginning of 2022. Now they don't know the future. They couldn't tell what was going to happen with Russia, Ukraine, energy spiking as a result, geopolitical unrest, but they did the equivalent of 17 rate hikes. Okay. They did the equivalent of 17 rate hikes, and we're still not down below 2%. So now here's what I want to do is I want to think about today. I want to go back to our original analogy, and I want to think about in the world in which we find ourselves in July of 2025, with the tariffs now being partially implemented. We do have higher tariff income this year. Tariff income is expected to be about $200 billion higher than what it was last year, the year before. There is actual revenue coming into the United States. At the same time, I'll also note that up until about a week or two ago, the latest data that we have, we are down deficit growth so far this year. It's grown about 200 billion slower than it did last year. Now, some of that's attributable to Doge, but we are adding to the debt slower than we did last year. Now we're boosting our revenue. That's before the business investment that comes in under this tax regime. But I want you to think about let's say tariffs go into place on August 1st, right? Let's say that these numbers move higher, that it isn't delayed further, or there's not agreements that are come to. Let's say too that the first Apple in here is a car. And you need to buy a car because your car broke down last night. You wanted to see if it could get fixed. You couldn't get it fixed. You looked at used cars. It turns out all the used cars in existence disappeared off the planet last night. So let's say that car prices are up 15%. Let's use a real world example. Ford has said our prices are up. GM, Stellantis says our prices are up. Now we have to think about how people react. And I think as this is realized, as we progress through the year, and we've already seen it in the inflation data, as the Fed kind of can't ignore it any longer, and that's usually the point at which they act, is when they can no longer say, just wait, just wait, just wait. I think this is what will trigger them to action. Think about what you would do if you had to buy a car tomorrow and cars cost 15% more. Okay, for most people that are out there, lower income, mid income, even for higher income, they say, look, if the car costs 15% more, most people aren't anticipating their income is going to grow 15% this year. Last year, in the last 12 months, income in the United States up about 3%. Okay. And that's why this is painful. You're 3% more income, but you got to pay more for the car. If you're not making 15% more, what you're probably going to do is make decisions about how you allocate in these other categories. And if you listen to the corporations talking about this, airlines have been talking about this, the hotels have been talking about this. Now, higher income, higher net worth individuals are not feeling as much of the impact. They're still going on the trips. They haven't really changed their spending habits, but some of the lower income Americans have. You look at what happens with Spirit, or you look at what happens with Southwest or Frontier Airlines. They're starting to see some trouble. And this is exactly what we see. So on the inflation side, okay, here's what I expect is that inflation is going to kind of move sideways, that goods prices will rise as those are what are most exposed to the tariffs. But a lot of the categories where people pull back on the services side is where it will be more moderate. The tricky part, Jeff, this is the trickiest part of it, is that a year ago, if you look at June, July, August, September, October, the back half of 2024, inflation readings were very soft. They were weak, usually at flat to 0.1%. So this year, even if we're staying in that range, 0.1%, it's going to make it look like on a year-over-year basis, we're not making progress. But if you stop and look at the last 6 months, if you look at the last 9 months and say, how much is inflation up annualized over those periods? Over the last 5-6 months, we're up 1.8%. Okay. We are now kind of within that range. And so if we don't see that realized inflation, which we didn't see in 2018, as a reminder, that's when we raised tariffs on China. And during that time period, certain pieces, microwaves, refrigerators, cars got more expensive from their components. We made decisions in other places, and inflation was actually lower in 18 than it was in 17 or 16. So that Jeff, that's my case, is that if inflation doesn't accelerate because of tariffs, and I don't think that's the driver, money growth in the system has been relatively flat. In fact, we're running below trend. I think inflation is going to be relatively modest. And at the same time, I think they're going to start noting it takes a little bit of time as the government and healthcare pulls back from employment before we really see that pickup in small and mid-sized business during that transition period, which is a very good transition, a very healthy transition. If I was designing an economy and I got to choose where the jobs got allocated, I want them in the hands of risk takers. I want them in the hands of people who have a motivation saying, I got to build this bigger, stronger, faster, better in order to grow my company and survive. That is how we've grown as a nation. That's how we've outperformed as a nation. Moving from a focus on government to a focus on the people is a phenomenal thing to see happen. Just watch over the next 6 to 12 months. So slower inflation, a moderation in employment, I think gets them to act in the later part of this year. That's my thesis.
Understood. I think we beat that down to where it needs to be, and we expect the Fed to respond accordingly is the takeaway, and it's based on the inflation slowing down for the offsetting reasons you just described, and the jobs numbers relative to government job creation not being the catalyst of what we've seen recently. I'm going to go back to why I called upon you, Andrew, and I think you went back and sort of made clear what has transpired over the last, give or take, 6 months since I last had you on. And of course, maybe it wasn't 6 months, it was closer to 3 months. Seems like a year. Let's go to the big, beautiful bill. I just want to summarize on that regard. What you're seeing is companies being in a position that they're not doing things just because of the tax benefits of the depreciation, 100% that's permanent. They're doing things because they see the opportunity. And as those opportunities are being created because of the competitive environment, because of the technological advancements, those, if I'm hearing you correctly, that's what you see really being the catalyst to economic growth and ultimate expansion of our market's valuations and the earnings that companies have been improving upon. You're essentially saying that's the real kind of, if I could, positive out there. It's not just because of, call it the government expansion. It's because of the actual our government programs that are causing expansion, like healthcare. It's because of the innovation and the motivation of the names and the companies that we've been watching for, whether it be generations prior to us or currently, and Tesla obviously being the leader there. That's what I'm hearing you say. Correct or incorrect, please?
Yeah, no, that's absolutely correct. You think about prior shifts in technology. You think back to the 90s, you go back to the 1930s and the broad expansion of electricity. When we have changes in technology, it creates opportunity, right? It creates volatility. As we know from investors, volatility, uncertainty create incredible opportunities within the markets if you've got the fortitude to invest through those. During this time period of uncertainty, how exactly will AI play out? Who are going to be the winners? Where is this going to show up? How will it impact jobs? Major questions that have been asked over the last 2, 3 years, right? In the early stages, when companies didn't have clarity that this was going to lead to earnings growth, that there was realized gains to be had during that time period, where they were investing heavily. If you watch Microsoft, if you watch Google, if you watched Apple and Amazon and Tesla, they did massive capital expenditures here over the last few years without fully seeing returns coming yet on those investments. Now we're reaching a point where you no longer need the government programs. In fact, I'll argue we didn't need those government programs to begin with, but it started some of the process earlier. Now we sit here and these companies say, look, the US, the 4% of the world's population that produces 25% of the world's output, the US that has the best legal system for us to run a company, the US, private property rights, rule of law, functioning democracy, again, incredible education system, best workers, people want to be here. The workers want to be here. If they could choose where to grow, where to work, where to raise their families, this is where they want to be. And now you've added to that an attractive technological environment, the best financial system. If you need funding, if you need growth, if you need access to capital, you're adding to that clarity on tax rates and essentially a guarantee that at least here for the next 2, 4, 5, 6 years, you are going to be one of the most accommodating tax environments globally. You're adding to that right now an incentive to heavily invest in research and development. When you think about projects, if you're going to do a project today that may pay out over 6, 10, 20, 30 years, which a lot of energy projects, if you look at nuclear, those are long-term projects. This accelerated depreciation changes the return on investment by 2 to 3% annualized over the lifetime of that asset. So by providing them with a more attractive investment opportunity, by providing them with an incentive to invest today to do that building, and promises that have started on the regulatory front, this is one of the best shifts I've seen in terms of the business climate. putting small, medium, and large companies in an environment saying, yes, there still is some tariff uncertainty, but the framework has been laid. Invest today, build today. We know the technology is here. The US wants to be the leaders. The opportunity is here. Now go and do it. And do
Yeah.
it not because we're telling you to do it. Go do it because you have this incredible opportunity. The US, the greatest wealth generator that this planet has seen, you have an opportunity to go out, take the risk, work hard, be exceptional, and be rewarded for that.
I think I've heard what I needed, and I think our audience has as well as it relates to the topic. What you're seeing is the reason this country was so great to begin with, and why my relatives and my generations before came from the old country to the United States for that opportunity to really have a country that is pro business, pro innovation, pro opportunity, pro a better life. We're bringing that back, in your view, with this, not a, hey, do it this year or it's not going to be available to you as much in the following years. Do it because it's opportunistic. It's technologically going to put us in a position that we want to make sure we're at the forefront of innovation, utilizing AI. So that's exciting. The tariffs not being as big of a problem as maybe some might think, or certainly the lack of clarity that it certainly provides some of my manufacturing companies on what their cost of goods are. We think that that's going to be offset by, one, more clarity, two, the structure to allow this country to be a leader in innovation and a leader in making sure that we continue to do the things for the reasons that will put us in that position, not because of a tax benefit. So I hear that loud and clear. We're coming upon second quarter earnings. I realize what you're saying is more elongated. It's more broader. I'll just reiterate a point that we talked about on a previous market update, and that the return on capital, the return on investment in our country with our public markets have gone from 4 to 6% now to north of 10%. And that's a direct correlation to efficiencies. That's a direct correlation to being more productive and using less to get that productivity to happen. I think we've got other aspects that'll peek their head in the coming years to concern ourselves with jobs. But as it relates to earnings for the second quarter, granted, we have the kick of that 250, I think you said, $billion of tax revenue that now will no longer be taxed. That's going to put the numbers on the bottom and the top line, or more importantly, the bottom line, to be much more opportunistic to valuations. That, amongst any other category, I know Brian Westbury, someone I respect a great deal, outside the the norm of what analysts were saying. He was concerned and pessimistic about monetary policy and the sucking of money out of the system. The regulation hopefully makes it more opportunistic. What says First Trust, and what says the leader as it relates to guidance on the economy and the numbers and inflation? What are you guys seeing that we should know? One, because as it relates to second quarter earnings that we just kicked off with the financials, and then what do you think the remainder of the year brings? What is your leadership saying, Andrew? If you can take us to that next step as well.
No, absolutely. There's anticipation on what is to come, and that was a theme kind of coming into this year. There was a lot of promises on what that would bring. The one thing I would say, is when we think we get the Q2 earnings, we're starting to see some numbers coming in, from example, from the banks, and what they're saying is, look, our lending environment's been a little bit better. People are getting back to activity, and that, remember, we didn't get the big beautiful bill until after June was completed, so we won't see the pickup that's going to come from that and the business investment that comes from that, taking advantage of these tax breaks, until the third quarter data into the fourth quarter data. There's still some questions. GDP in the second quarter is going to be strong because that headwind that came from the massive imports in the first quarter, that's a detractor from GDP and how they run the calculations. It'll turn into a tailwind in Q2 simply because we're not importing as much. In the short to intermediate term, expect there's going to be a bit of a bumpy transition. If you've got a garden, outside, and the garden's the soil's been depleted and it's got some weeds, and there's things that need to change. There's things that can be done in order to have it produce more bountifully, more prosperously into the future. One of the first things you do is you dig up what needs to be taken out. You dig up what's wrong, and then you start that process over, rebuilding correctly. And so, again, on the jobs front, expect to see some moderation. On the inflation front, expect to see some moderation towards that 2% number. GDP this year is still going to be running, at normal levels, 1 to 2%. We're laying the framework for 26 into 27 and moving forward, as we've seen over the last 2, 3 years, as capital was being allocated towards building AI investment, data centers. Once the shovels go into the ground, that starts the process. But then it's got to be built, it's got to be powered, it's got to be protected. There's a lot of lines going in, a lot of cybersecurity work taking place. And 6, 9, 12, 24 months later is when you start to see that really taking off. So in 2025 as a whole, there's still some things to be figured out. I do still, and Brian Westbury, the chief economist, my boss, when we look at the markets, there's some bifurcations that are taking place. There's some areas where companies have really been bid up really high, and then there's areas that have been completely ignored. And so this year for us is an opportunity year. Figure out who gets the best impacts from some of these tax law changes, who has that international exposure, who's going to benefit now from the lower foreign taxes that's going to bring it in, who has those deferred tax assets. Now, I wish there was, a golden portfolio or a golden, way of investing and saying everybody do this. But Jeff, you know this all too well, and your team does. You've got so many people coming from so many different areas within life. Their revenues are coming from working in a certain industry, and so it makes sense based on where they stand today and where they want to go to take advantage of this in different ways. That's why I would say this is a critical time period right now. Add in all of the changes that are happening, more opportunities for deferred taxes with the individual side, more exemptions that have been put into place, increased limits now on small, medium-sized business ownership, and the revenue generation from there. First Step should have a conversation with you. But as we go through this year, expect a little bit of bumpiness before we smooth out that ride. Let's get those feet reset, get the investors, the entrepreneurs, the innovators really plugging in under this new environment and watch them take off.
I appreciate that. That's what I'm hearing in our words, getting to the point, if you will, is good things today, better things tomorrow,
Yeah.
and bumps along the way, which we're used to. I would ask the last comments, if you will, on your end, and let me just kind of frame it, if you will. So here's where we're at. We have earnings growth that is expected to be more to the beat by about 28%. Companies told us with their guidance in the first quarter, we expect to do a little bit better. 55% of the companies said, hey, we're going to deliver what we promised. And there's a lower number there of companies that, say, hey, we might have to take our numbers down a little bit due to the uncertainties that you pointed out. But in general, earnings will be meeting expectations at an increased, better than expectations at a typical 70% clip. Interest rates we're expecting to come down on the short term by as much as 50 basis points, says you, Andrew. The market says a quarter in September, but the rationale that you use for jobs is being a big factor, and the fact that the jobs are being affected by less government jobs and more opportunistic, call it innovation. Those are things that will be watched by call it Federal Reserve. You don't believe tariffs are going to be a factor to the concern. The data will drive us, as well as the concern of the tariffs will not be a factor. You have a innovation of technology, of us getting things done in a more direct, call it productive fashion with more streamlined innovation. How do you play that? We, as I can look back to 2022, we saw the chip sector being a hot topic. There weren't enough of them, as you pointed out. There weren't enough apples, but there were more dollars chasing those apples. There weren't enough chips. We did our own research. We worked with our third-party managers and analysts to say, okay, how do we play this? We played it. We played it well. It worked. And then we looked at energy, the infrastructure. We talked about Oracle today. We talked about data centers. We talked about all of that spending billions upon billions of dollars just in companies alone. Microsoft buying 3 Mile Island, getting that nuclear, getting that energy. We see that as an unfolding, call it infrastructure and demand play, and the supply catching up with it. Now we're looking at the next phase, which is the AI, the bots, the innovation actually taking hold. And then, of course, we'll start to look at the benefactors, the companies that will see return on capital, that the value side of the call it investment opportunities could become the more impacted. How do we play? And if you could, Andrew, and if it's not your lean, be honest, and we'll pivot to someone else. But how do we play this next chapter? Wayne Gretzky used to say, "I wasn't so concerned," and he's the great one, right, for hockey, where the puck was. I'm looking more for where the puck's going. If you don't mind planting a couple seeds, and then I'm going to summarize for our audience because I've taken us a little later than I anticipated. I'd love that, Andrew, please.
Yeah. So when we look out and think about how AI is impacting, how it's being used today, the growth that it's seen in terms of its capacities, I still think it's too early to tell exactly how this is going to play out. When will people have robots in their homes? When will we see AI making larger scale replacements on manufacturing chains across the United States? And we one of the things that I did when I was going through grad school is I did a lot of work on technological advancements. What happened when the internal combustion engine came out? What happened with the growth of the internet? What happened when typewriters replaced people that were doing things by hand? And we're always surprised the deeper we get into it and just where we find those opportunities. There's a couple areas from an investment standpoint that I think we're going to need and continue to invest heavily in areas like cybersecurity. I don't know of anybody who says, oh, yeah, we're going to need less cybersecurity in the future than we do today. Data transmission, data is the critical piece behind this. As language models get more complex, as AI gets more complex, the way that it's able to do more is not just because it can do things quicker, but it can take in greater and greater and greater amounts of knowledge. So, data transmission, the lines that are going into the ground, the speed at which we can transmit is going to be another critical piece of this. And then when you think about it, again, a lot of that comes down to driving the efficiencies for corporations. So being in the market, and we're sitting here at a point in time where people are living longer than ever before, and we're gonna benefit in later in life into retirement from some of the leisure that this opens up by robotics and AI reducing. If you think about the last 50, 100 years, where we stand today, before robots, we do less manual labor as a country, as the average job than we ever have before because we figured out ways to allow technology to free us up to do other things. This is going to continue us along that path. And so, medical is going to be a focus. We've got an aging population, and this is an area where AI, by doing compound computations and by being able to more quickly earlier identify where some things are starting to show up, I think medical is going to be a field that's heavily impacted. But again, for me, power is still important, data transmission is important, cybersecurity is important, and then that broader trend of the asset owners. If you are the company and you can apply AI, it drives efficiency, drives productivity, drives that return on invested capital. We have an opportunity to invest alongside them and enjoy the fruits of those rewards over the years.
Excellent, Andrew. My mute button always gets stuck. Excellent. Thank you for your feedback. I think what you bring to the table is a more granular view, and I think you simplify it in a way that's very helpful for me, and I'm hoping my audience as well. I'm just going to summarize in my words, if you will, the internet that came to us in my early phases of my 30-year, call it working career, was something that gave us information quicker. It gave us the ability to communicate and do things more effectively based on that communication. Instead of going to the library and digging into a book that we're going to gather information from, we had the ability to go online and get the information quickly and then be able to get that information anywhere in the world, regardless of where it's happening. And then us having the ability to communicate like this across the globe. This next phase is taking all of those libraries, all of that information, all of that data, bundling it up in a little tight ball that they can calculate how to utilize it to solve issues that we haven't even thought of: autonomous vehicles, execution of transactions outside of the SWIFT system, things that we haven't even thought of. If we think we understand what this next couple years, 5 years is going to look like due to the impact of technological advancements, I'm here to tell you, we didn't know in 1995 what the internet was going to do, and we don't know today. And I will also say the impact that the internet and technological advancements and efficiencies that have come from it, that have been explosive to our return on capital and efficiencies, I believe that it's going to be if it's 100 times more impactful, it's 1,000 times more impactful. And I think we have to, as we all do, change makes us apprehensive. What's it going to do to my cheese? What is it going to do to my job? Am I going to be necessary? Am I going to be relevant? Let me tell you something. Set it aside, because you can't stop it anyway. It's coming. Embrace it. Figure out how to benefit from it, figure out how to utilize it, which is exactly what you're saying, Andrew. Okay. And that's the way we need to approach this. Embrace it, because we can't stop it anyway, in spite of ourselves. So what is our job? Our job is to understand all of the unknowns as well as the knowns and protect and guide you through those mazes. Make sure we have enough cash and capital to get us through the unknown as well as the known, and make sure that we have our money growing to combat purchasing power, so that our legacy and our next chapter of life, because I believe what I heard you say is healthcare is going to be affected and we're going to live longer. So if we're going to live longer, our money better do the same. And if we're sitting all in conservative investments, expecting that to carry us with purchasing power when we're hopefully having a better quality of life over 100, which is my hope,
Mhm.
we're going to have the capital to ultimately implement and live. And then finally, leave a legacy. That's our job. Our job is to understand your vision and make it our mission to utilize Andrew, utilize our resources, utilize tax professionals, estate planning tools and vehicles, as well as people to get you the solution that you desire for your vision. And folks like you, Andrew, and my team of folks that are here and our multiple branches across the country are ready, willing, and able to have the care and the culture that I think is going to help us all get to our goals, moving in the same direction with the same objectives. And I thank you, Andrew. I thank my team, and I thank more importantly my audience for giving us the opportunity to deliver this type of message, to continually work hard for you with the passion that I hope you feel today. And I wish you all the best, and I'll see you soon. Thank you, Andrew.
Thank you. Take care.